15th, then we'll look at your test at the end. Maybe more people will be here. Uh, anyway, I'm gonna have to get you to help me grade the problems. I've got your Scantrons. Uh, Tony Hood's not here, but he got a perfect 10 out of 10 on the multiple choice. And then somebody got just 3 of the multiple choice.
Probably me.
No, that person's not in here right now. So, you're gonna mix me up. I don't know where I went to here. I went to go to PowerPoint. How about the flood? Did it bother anybody? Now, my grandson down in Cleveland, Tennessee, and my daughter-in-law teaches in Chattanooga. They're both closed today because of more rain and flooding. I don't know how bad Buchanan got hit, but I know Richlands got hit and door ran, what have you. So, all right, we looked at this a little bit last Tuesday. You had the test on Thursday. You should have read this chapter. Everybody should have Cengage brought up through chapter 12. Now, if you don't, I'm going to go in and put a deadline on it where you can't go back in and do anything. So, Cengage, I'll put a deadline on it probably Thursday. Thursday will be the deadline. So, please have chapter 12 brought up to date. Now, I know these 3 ladies up here, you have Cengage all the way through chapter 12, right? Travis, you do. But now, Anthony, have you got caught up with chapter 11 on Cengage?
Yeah, I'm working up on it.
You-
I should be caught up.
Are you working on 12?
Yeah.
Okay, good, good. See, Anthony joined us a couple of weeks late, so naturally he would be behind. But anyhow, I went down and looked at that river down in, it's called a Doran Bottom. Those houses are built right on the river, and they all get flooded, at least the basement, maybe the first floor. A lot of churches in the area are joining in to help clean up. My girlfriend and I took a bunch of stuff by the police department, heavy duty garbage bags, gloves, water, bleach, paper towels. We took a lot of that stuff by that will help. But now I'm sure some people will go by that police department, they didn't get a drop of water in their house, and they'll pick up a lot of that food and clothing and supplies. People do that, you know. Anyway, just to review a corporation, it's a legal entity, and that means it can be sued just like an individual, and it's just like your name. You're a legal entity yourself. You start a proprietorship, it is not a legal entity. It goes back to the owner. A partnership is not a legal entity. Everything goes back to the owner. Proprietorship and partnership do not have to file tax returns. A corporation does. Now, the owners of a corporation, we know, is the stockholders. And that's why we have stockholders' equity now instead of capital in your accounting equation. Shareholders vote in a corporation. They will elect a board of directors. They will elect a CEO and so forth. The board of directors sometimes appoints the CEO. So the organizational structure, which you've got that in management, goes from the stockholders to board of directors, CEO, and other officers down to the employees. And probably about, if you stopped at any place, some place you might have stopped at a proprietorship. Some of these little zippy markets might even be partnerships. But you know, when you get Walmart, now, what do you think is the largest retailer in this country? Walmart, and probably in the world. What do you think is the largest uh, automobile company? Probably General Motors. Okay. Now Toyota may have more sales than General Motors, but they're not incorporated in this country. Okay, how about tires, the largest?
Goodyear.
I'm not sure. It used to be Firestone. It could be Goodyear now. I'm not sure. How about software?
Microsoft.
Microsoft.
Apple.
How about hardware? Computers.
Or Apple or HP.
I know HP is heavy, and so is Dell.
Yeah,
All right. Now, does Apple make computers?
Yeah, yeah.
Well, they make a lot of laptops and Surface Pros and iPhones. But I still think it's either Dell or HP leading in the, in the cell phone industry. It probably is the iPhone, isn't it?
Yeah.
So we have large everything, large clothing manufacturers, large appliance manufacturers, and so on. But the largest one of all of those, it usually runs between Exxon, General Motors, and Walmart. They're the three biggest, Exxon, General Motors, and Walmart. And those are big corporations. Now one of the people running for the Democrat nomination, you don't see him much, he's a billionaire, and his name starts with an S. He's proposing a $22 minimum wage. Well, how much do you pay for a Big Mac right now?
$5 or $6.
Let's say $5. Minimum wage is $7.35 nationwide. If that minimum wage tripled, you'd be paying $15 for a Big Mac. Or McDonald's would go automation like Walmart. Go with automated services or robotics. See, the mining industry, when employees, when human factor, and there was strikes and unions and walkout strikes, the mining industry went to machinery and used less people. So, anyway, characteristics of a corporation, they do pay federal income tax. I think Trump leveled that out at 20%, I think. And you would have to pay taxes on dividends that you get from earnings or capital gains. Now, if you bought a $10 share of stock and it went up to 15, you have gained $5 in capital gains. And you have to pay 15% tax on that, or no more than 15. You may have gotten $1 dividend. So you get income two ways, dividends and capital gains. That could reverse itself. It could go down to $7 and you could lose. But right now, stocks are at an all-time high. And if you can see these advantages and disadvantages, it's separate from its owners. It has continuous life. If one stockholder dies, it continues. It could raise more capital. It could sell shares of stock, and the stock's transferable. It has limited liability. The owners cannot be sued. Corporation is sued. Disadvantage, owners separate from management. You got double taxation and a lot of regulations. The double taxation, if you got $1 in dividends, it's paid to you after the corporation pays federal income tax. So they pay taxes of like 20%, and on your dividends, you may pay taxes of 15%. That's called double taxation. Now, if you get in on the grounds up, I got in on the grounds up. First Sentinel Bank started in Richlands, and I bought a little bit of it and sold it out later. I regretted that, and I bought some back later. But if you can get in on the ground floor of some of these companies, wouldn't you have liked to bought stock in Facebook or Amazon or eBay a long time ago? Or Microsoft or Walmart? you could have made a fortune had you bought into those companies. I bought a 1972 Monte Carlo in 1972. I paid $4,000 for that Monte Carlo. It's gone. It exists no more. It wore out. If I'd have put that in Microsoft, I'd have been worth hundreds of millions. I'd have been worth a lot of money by that 4,000 investment. We can't foretell the future. All right, corporations, where they're located, we glance at those. Forming a corporation, we sell stock. And we have organizational costs that we debit and we credit cash or accounts payable, whatever. Now, sometimes you can amortize these, but we'll worry about that later. I went in with a couple of professors one time. We started a corporation and we gave the lawyer a few shares of stock for his legal fees. So we did not. We had to debit organizational expenses and credit common stock. Okay. All right. Assets is equal to liabilities plus owner's equity. Okay. Let's go with stockholders' equity for corporation. Stockholders' equity. Everything else has paid in capital. If we get a premium on selling stock, net income goes into retained earnings. Retained earnings is where your net income goes to in a closing entry. Where do you get stockholders' equity from? You get it from income, retained earnings. You get it from selling stock and a premium on that stock. That's where your equity comes from. Reinvested earnings, you're buying back treasury stock. Now, net income will increase retained earnings, and we know a loss will decrease retained earnings. Well, if we pay out dividends, it decreases retained earnings. In proprietorship, what increases your investment in a proprietorship? Additional investment and earnings, right? About the same thing with a corporation. Withdrawals decreases your capital, whereas dividends decreases your retained earnings. A lot of similarities. All right. They may authorize, and I think there's a chart coming up here, they may authorize 100,000 shares of stock, and they may issue 80,000, but there may only be 70,000 outstanding. Do you remember last week which one did I say you paid a dividend on? Authorized, issued, or outstanding? Which one do you pay a dividend on? Outstanding. Now, why do you issue 80 and there's only 70 outstanding? You bought 10 back, called treasury stock. And I told you stock had a par value. When Bill Gates started Microsoft, how do you write 1/10, Fraser? 1/10 of a penny.
0.40 and a 1.
Well, that would be a penny.
4 zeros would be a penny.
Well, no. 101 would be a penny. Wouldn't that be?
That'd be a penny.
No.
If you're making it a percent.
No. Let's see. Right here would be a penny.
Oh, I thought you were talking about percent.
All right. Yeah, 1/10%. How would you write it? All right. How many shares of stock could you buy for $1 if they cost you 1/10 of a penny? How many shares could you get for a penny?
100.
No, 1/10 of a penny. For 1 penny, you'd get 10 shares, right? 1/10 of a penny, you'd get 10 shares. So how many shares would I get for $1? 1,000 shares. So when Bill Gates started Microsoft, he made the par value at 1/10 of a penny. Now, if he put in, you know, $100, imagine how many shares he would have. Now, over time, those shares split. And over time, those shares went up, not to 1/10 of a penny, but around $90 a share. And that's why Bill Gates became, for a while, the richest man in the world on paper. He's still rich on paper. He just donated $100 million for this Chinese virus for research. So $100 million. And Bloomberg has spent $300 million on his campaign so far. So how many zeros does a billion have? All right. How much is that? How much is that? All right. How much is that? Well, let me move that comma down there some and put another zero. Now, how much is that?
So now you-
All right. Now, if I put three more zeros, how much is that? It's a billion, isn't it? $1 billion is a lot of money. Now, our national debt is approaching 20 trillion. I guess if I put three more zeros, I'll have trillion. A trillion is what? 100? No, it's 1,000 billion. A billion is 1,000 million. A million is 1,000, what, 10,000? 1,000, 100,000, something like that. Anyway, that's a lot of money. You can stack $1 bills to the moon and back. Bloomberg would stand on the street corner and hand out $1,000 bills as fast as he could, and he would probably die before he gave out all of his money. That's how much those billions are. Classes of stock, we normally have two classes, common and preferred, and we make interest for both of those. Common stock votes, common stock probably gets more than dividends. Now, Alicia, what did cumulative preferred stock mean? We went over that last Tuesday. What did cumulative preferred, what does that mean?
All the stock together, the overall stock.
Does anybody remember? Preferred has preferences, but what does cumulative preferred stock mean? Does anybody remember? You pay dividends in arrears. If you can't pay dividends in 2019, you pay them in 2020. You pay off dividends in arrears. preferred stock might get preference to assets too. This company has 20,000 shares of CUNA preferred 1% stock of $100 par and 100 shares of what have you. The following amounts were distributed. Now we went over this last week. 1% on 100 is $1. And if you got 20,000 shares, that's $20,000. Or you can multiply 100 times 100,000 times 1%, and you'll get $20,000. So, how much does preferred stock get in year one? How much does preferred stock get in year one? The whole 10. Now, how much do you think preferred stock will get in year two? 30. Now, how did I get 30?
Add the 10 on the 20.
What?
Add the 10 on the 20.
The 10 in arrears. Alright? And common gets 15,000. There's nothing in arrears, so preferred gets 20 here, and common gets the remainder. Now you can see it here in this chart also. Preferred gets 10, 30, and 20. There's 10 in arrears here. No, nothing in arrears here. We looked at that and we'll practice that later. Now issuing stock, we're going to debit cash and credit what? Common stock or preferred stock? Now if we issue it above par, we're going to debit cash and credit preferred stock and credit paid in capital. The par value of that stock was $50. That's what you credit preferred stock for, $50 a share. The remainder is premium. Premium is called paid in capital. Now we can take land in lieu of stock. And we debit land, credit common stock, and paid in capital if the land is worth more than the par value of the stock. No par stock works the same way. Debit cash, credit common stock. But now if they put a par value on it, you'll debit cash, you'll credit common stock, and you'll credit paid in capital in excess of stated value. All right, read the example, look at the answers. $30 times 50 is $450. Debit cash, credit common stock. Debit cash, credit preferred stock. Now here we sold some preferred stock for a $2 premium. Debit cash, credit preferred stock, credit paid in cash. All right, cash dividends. All right, that's paid out of retained earnings. You must have cash. The date of declaration requires a journal entry, and the date of payment requires a journal entry. Does anybody know Latasha, or has anybody seen Latasha? She hasn't been here for 3 days now. She's doing well. Okay, I guess Marcus had his surgery. Finished? Must not have been hard.
Did like 9.
It must have been, I don't know, it must have been easy though.
Wasn't too bad.
All right, we debit cash dividends and we credit cash dividends payable. And then when we pay the dividends, we credit cash and debit cash dividends payable. All right, folks, there's a lot of information in this chapter. Please read it. I'm going to give you some assignments. Please do them. Please work on Cengage. Now, a stock dividend all right, what is 2 million shares times 5%? It's 100,000 shares. We're going to give 100,000 shares stock dividend. We've got to credit the par, of course. And that's called stock dividends distributable. Okay? This is the par value. This is stock dividends, the total value. And the difference is paid in capital in excess of par. And then we distribute that stock and credit common stock. Stock split, you just make a memo entry. You don't make an entry. If stock is on your books at 100,000 shares at $10 a share, and you split this stock 2 for 1, you're going to have 200,000 shares at $5 par. You double the shares, split the par. Treasury stock transaction, you're buying back your own stock. That way, you got more control of the corporation. Or it's done good, you can sell it at a gain. So when we buy back treasury stock, we make a simple entry. We debit treasury stock and credit cash. But how much did we pay for it? We paid how much a share?
45.
$45. Now if we sell it, we're going to sell some of it for what, $60? So we're going to have a $15 gain. And we're going to pay it in capital for that $15 a share. And likewise, if you sell it at a loss, you will debit paid in capital for that loss of $5 a share. Okay, here's something we must know. Stockholders' equity. Now, you know what assets are, and you know what liabilities are. Well, this is the third part. Preferred stock goes first, common second, paid in capital third, retained earnings fourth. You've got treasury stock, you subtract it out. Here is the best form, but up here you go preferred stock, excess over par. I like the second statement better. Preferred stock, common stock, paid in capital on both stocks, and then retained earnings, and then subtract out treasury stock. You will have to learn to do a stockholders' equity section. Now we have a retained earnings statement. It's about like a capital statement. You take beginning retained earnings plus net income, subtract dividends, and you've got ending retained earnings. It's about like capital. Add net income, subtract withdrawals. Here you add net income and subtract dividends. It's only different. Add net income, subtract dividends. So a retained earnings statement is real close to a capital statement. But now this balance sheet, this is totally new to you. And we'll have to practice some stockholder equity sections. I'm not worried about prior period adjustments yet. Here's your balance sheet again. Taco's equity section. Morning Joe's. Y'all know what Morning Joe's is, don't you? Isn't that a real company? Isn't that a real coffee company? Similar to Starbucks, but it's not as big. I believe it's in a lot of the bookstores or,
That's Jermo's.
huh?
Jermo's is what's in the bookstore.
Morning Joe's, it got another name.
It's just Jermo's.
Oh, okay. All right. EPS, earnings per share. You take your net income. This is a ratio, which we'll have a whole chapter on it. Right here, take net income minus preferred dividends over number of shares of common stock. Shares of common stock only to get EPS. All right, that's pretty much the chapter, folks. And let me give you an assignment on chapter 13 for Wednesday. Should have read it already for today. I want you to do some exercises. I want you to try number 2 exercise, number 3, number 4, number 5, 1, 2, 3, 4, 5, 8. Try 10. All right, try those entries between now and Thursday. Okay, at this point, I'll quit live streaming. Now, you folks out there, there are 5 students out there that signed up for online accounting, and only 1 came in to take the test Thursday. That means 4 of you are still out there. If you're not going to take the test, and you ever watch these videos, please withdraw. I can withdraw you when you miss 3 times. I've not heard from any of you 4, but I don't like to withdraw students. I like to give them S, because you're old enough and mature enough to withdraw yourself. Okay? So I hope that happens. I hope you withdraw.